Welcome to Operation Silent Trigger. In this video, we'll break down the week's market action, analyze the quote scam that wasn't, look at the new Fed chair's impact, and see why semiconductors are surging. At Hollow Point Trading, we believe that dull entries miss the mark, but hollow points always expand. Everyone told you to panic. They said it couldn't last, gold was dead, it was a scam, or the top was in. But the week the noise was loudest was the week the signal was cleanest. Let's look at what the tape actually said. There are two kinds of traders, the ostrich and the operator. The ostrich reacts to headlines and TikTok trends, while the operator asks what they are missing, reads structure, and treats the crowd's stop losses as entry points. This is our map for the week. We'll cover everything from the rare volume tell in the semi-engine to the new Fed chair, market breadth, and the recent market rotation. Part 1. The volume tell. Thursday's market action left a distinct fingerprint. We saw buy volume at a size that is only printed a handful of times, and historically, every time it prints, it matters. As you can see from the data, this wasn't just a drift higher, it was a stampede. This kind of size doesn't show up at market tops that are about to fail. Smart traders front-run this by knowing the tell, not by chasing the candle. We see the same fingerprint on both the S&P 500 and the Nasdaq. When the two largest indexes print the exact same bar-for-bar pattern on record volume, that's not a coincidence. That's a coordinated bid to accumulate the dip. The catalyst for this move? One word: peace. While it was doubted by the crowd, the market stopped pricing in war risk and re-rated higher in a single session, confirmed by moves in crude and gas. Here is the pattern decode: breakout, undercut, liquidity grab, and rip. Algos know exactly where retail stops live, so they hunt for them. Smart traders recognize these stop zones as potential interest zones for the next reversal. These are the only levels you need: 12, 22, and 55. Use what fits your style. Keep in mind that as long as we hold 7,400, the trend is up, but a close under that level puts a retest of 7,250 on the table. Part 2. The engine that never stops. Semiconductors run on one primary fuel: earnings. As long as earnings growth continues at this unprecedented pace, the index will climb. Since the March base, semiconductors are up 84%. While many fight the move, thinking this can't continue, that disbelief is exactly what fuels the next leg up. Don't be the ostrich. Do the work and measure the move. We have 20 years of data that support one rule: the index stops rising when earnings stop rising, not before. Volatility is simply the toll you pay for the trend, not a sign of the trend ending. We are seeing growth like never before. Companies are raising billions to secure chips, and analysts are scrambling to raise their estimates. This is a massive global build-out, not just a temporary hype cycle. Look at Micron as a case study. With $50 in earnings power, the market is pricing in significant growth. When you see this kind of momentum, stop asking why it's up and start asking how you can get involved. Looking at the semiconductor sector, the beat ladder just keeps stacking. We're seeing consecutive beats that far exceed expectations. It's exponential growth, and the skepticism that it can't keep going lacks fundamental evidence. Comparing today to the 2000 dot-com bubble is misguided. Back then it was all hype based on eyeballs. Today the semiconductor sector is driven by real revenue, real earnings, and accelerated growth, backed by massive capital expenditure. The multiple isn't the story, it's the cash. While dot-com companies were trading on future dreams, current semiconductor leaders are producing earnings you can actually bank. The skeptics may be the same, but the math has fundamentally changed. The belief that it can't last is often just a trap. It keeps the crowd on the sidelines while the trend continues. Remember, until earnings actually roll over, the skeptic is usually just narrating their own exit. Homework mandate number 1. Understand the why, or you will miss the when. If you rely on borrowed conviction, you'll likely sell at the first sign of red. True understanding is the only thing that protects your position. Now let's look at the silent trigger. We have a new Fed chair, and the rules have shifted. It's shorter, simpler, and lacks the old dot plot and forward guidance. The Fed has gone quiet, and in this market, silence is a signal. This regime change is very Greenspan-esque. We are seeing fewer words, less handholding, and more reliance on market dynamics. The change is structural, focusing on brevity and reduced guidance. First, the official statements have been cut in half, from 300 words to 130. It makes our job easier. Read it in 10 seconds and move on. The economy of language is officially back at the Fed. Second, the personal dot plot is effectively gone. If the chair isn't using it, it doesn't hold weight. We are moving away from trading based on what-ifs and potential future hikes. That kind of fan fiction is finally dying out. Third, the lack of forward guidance creates a truer market. Equities are now moving on their own merit rather than reacting to phantom Fed moves. This leads to more honest, tradable volatility. Fourth, 5 new task forces have been announced. This signals that the current machinery is viewed as antiquated. It is a clear intent to structurally rebuild how the Fed processes and communicates data. Fifth, there is continuity in senior staff. We aren't seeing a purge, just 2 added interim advisors. Markets appreciate this blend of new style, mixed with established institutional memory. Finally, press conferences are no longer guaranteed. Following the mentor's mantra, they will only speak when there is actually something to say. From now on, a scheduled presser becomes a major tell for a policy shift. When you put these changes side by side, the shift from the Powell era is stark. We are moving toward a more disciplined, less vocal Fed policy that emphasizes clarity over constant communication. So what does this silence do to the bond market? It creates a, quote, quiet bid. With less fear of surprise soundbites, buyers are more confident, leading to stability in yields. Certainty brings money into bonds. Moving on to what changed after the meeting, and the honest answer is, not much. The 10-year saw an initial dip before ringing back, showing no structural change. Meanwhile, the dollar is exploding higher, a classic sign that money is coming home. Why does a strong dollar pull money home? It's a loop. As the dollar rises, the world needs more to buy oil. Those petrodollars are recycled, ultimately flowing back into U.S. assets. A strong dollar and stable treasuries often signal a bid that doesn't appear on typical volatility charts. Next, let's look under the hood. Breadth tells you the environment. We were recently the most oversold we've been in the short term since April, yet breadth was quietly improving. That's a divergence that rarely lasts. Here is our breadth dashboard. We track the percentage of stocks above their key moving averages. When the short-term lines flush while the longer-term lines hold steady, that is a coiled spring, not a market collapse. The majority of names being below their 5-day average is the most we've seen in months. This is what we call a washout. Wednesday's undercut acted as the spring, proving this was a panic low rather than a structural break in the trend. Remember the 50-day line. When we are above it, support shows up and swings are easier. It doesn't guarantee the market will go up, but it does promise a better trading environment. Below it, everything becomes a fight. This is a classic divergence. The price makes a new low, but breadth refuses to confirm it. More stocks reclaiming their 50-day while the index prints lows is a tell that the low usually won't hold. It's a directional signal, not a calendar event. We call this the 50% rule. When we are above 50% of stocks holding their moving averages, it is a green light to swing trade. Below 50%, you're dealing with chop and frustration. Stay above that line, and your trading life gets simpler. Looking at the Nasdaq, the index snapped right back above the 50 level. Wednesday looked like a potential break, but Thursday's headlines provided the catalyst to reclaim the level. The Nasdaq is currently gaining breadth, not losing it. On the longer 200-day time frame, my only ask is that over 50% of names hold their average. As long as that is true, the long-term trend remains intact. This divergence takes longer to form, so watch it patiently. Breadth up, while the index is down, is inherently bullish. It is simply not possible for more stocks to climb above their 50-day while the market fundamentally worsens. They cannot diverge forever. The resolution is rarely a mystery. Homework mandate number 2. Trade the environment the breadth gives you. Stop demanding it calls the exact bottom. Above 50% is a green light. Below it, tighten up. The tape always rewards the patient over the precise. Part 5. The fear trade unwinds. Gold, crude, and yields are all rolling over. The hedgers are voting that inflation has peaked, and geopolitical fears are fading. Listen to the market's capital allocation, not the social media noise. Gold is seeing the reversal everyone fought against. When everyone insists they must own an asset, that peak FOMO often signals a top. The fear bid is currently unwinding across the board. Finally, the 10-year yield is collapsing, and that is exactly the point. Yields are easing because the tape is getting healthier. A strong dollar paired with falling yields is the cleanest cross-asset confirmation of a shifting market. Crude oil is showing weakness, falling below the control bar. The commercial hedgers are the smart money here, and they aren't pricing in a return of the war. With both crude and gas signaling weakness, we're focusing on the actual market positioning rather than the news cycle. It's important to distinguish between signal and noise. Hedgers are managing real capital and risk, and they are currently positioned for cooling inflation. Meanwhile, social media narratives pushing a, quote, war risk comeback are directly contradicted by the price action in crude oil. The numbers speak for themselves. Gasoline is down about 22% from its peak and is breaking the $3 level. This drop in fuel prices is a significant indicator that eases inflationary pressure and improves margins for many businesses. Many are misinterpreting the VIX collapse as a sign that all risk is gone. That's a surface-level reading. To understand the true risk environment, you need to look at other signals, like the 10-year yield, and identify the driving forces behind current market movements. Our cross-asset board shows a consistent trend. Gold and crude are rolling over, the 10-year yield is collapsing while the dollar is showing strength. This alignment provides a clear picture of the current market rotation. Cheap fuel is effectively rerouting capital. When oil prices are down, profit margins expand for sectors like airlines, leisure, and industrials. These areas are showing signs of breaking out as the market rotates. The trade logic for airlines is straightforward. Fuel is their primary cost. When oil drops, their bottom line improves. Monitoring the jet sector allows you to follow this broader trend and identify specific opportunities. It's notable that the airline sector still hasn't reclaimed its pre-COVID highs. This level of depression relative to the broader market presents a unique, low-beta opportunity to capitalize on the lower fuel costs, especially with the summer travel season ahead. The leisure and entertainment space is showing signs of life. We are seeing money flow back into cruise lines like Carnival, Royal Caribbean, and Norwegian. This is part of a broader trend where capital is moving into these sectors. When watching for a potential turn in the market, keep an eye on key technical levels like the 12, 22, and 55-day averages. It's better to let the market prove itself rather than guessing the bottom. Set alerts for breakouts above the 50% line. The energy sector is showing clear signs of technical breakdown. With names like Exxon rolling over and the neckline of a head and shoulders pattern failing, this area is looking like a potential short opportunity. However, nuance is required. Not every energy stock is a short. Refiners, for example, can remain profitable even as crude oil prices fall, as their margins depend on the spread between crude and finished products. It's ironic that industrials are hitting new highs, despite recession fears. The market narrative and the actual price action are in disagreement. Strength in sectors like data centers is driving this upward movement, indicating a healthy, broadening market. Take a look at Caterpillar as a case study in market behavior. We saw a textbook setup, a breakout, a retest on news, and then continued momentum. It's important to watch the behavior at the open, rather than just looking at the daily close. In the case of GEV, we identified an opportunity after seeing exhaustive selling volume at a key level. When the next day's price action failed to push lower, and the retest showed reduced selling pressure, it provided a clean entry point for a reversal. Looking at the data center rotation, there's significant capital flowing into this space. We are seeing major names sitting just off all-time highs as the industry enters an upcycle. It is one of the most critical areas to watch right now. Our rotation scoreboard highlights where the money is moving. Airlines are benefiting from collapsing fuel costs, industrials are surging on data center infrastructure demand, and semiconductors are showing strong leadership based on earnings reports. When dealing with new issues like SpaceX, focus on the range. Currently, it is trapped within a box, with 170 acting as the floor and 190 as the ceiling. These new issues reflect human behavior, not magic, so trade the boundaries until a breakout occurs. Let's analyze the box for SpaceX. 190 represents significant supply where gap fills are rejected, while 170 is being defended by real buyers. The range is tightening daily. Watch for a break to decide the next major leg. The IPOV-WAP is perhaps the most critical tool for new issues. Once a stock drops below its IPOV-WAP, it remains under pressure until that level is reclaimed. For SpaceX, reclaiming this volume-weighted average price is more important than any other single price level. We see the same tool working across different stocks. Whether it's CVNA or Coinbase, the IPOV-WAP consistently acts as a pivot point for institutional interest. Monitoring how price interacts with this line reveals the true strength or weakness of a new issue. By looking at the volume profile for SpaceX, we can see that the most significant value has been established between 150 and 200. This indicates where the majority of shares changed hands, with the current price action tightening like a coil. At the 170 level, we have a clear point of confluence. It combines a 38.2% Fibonacci retracement, the point of control from the volume profile, and historical buyer interest. When multiple tools confirm one level, that price becomes a high conviction zone. These levels work precisely because they are widely watched by institutional traders. They act as Schelling points where order flow concentrates. Remember, we aren't predicting the future. We are mapping human behavior at known decision zones. Your decision tree is simple. If we claim and hold the IPOV-WAP and flip 190 into support, the path is bullish toward 200. Conversely, if we reject 190 and lose the 170 level, look for an air pocket toward 150. Hierarchy of indicators is key. On new issues, the IPOV-WAP is the absolute priority, often taking precedence over traditional moving averages like the 50-day. The price levels defined by our quote box are the final piece of the puzzle. To summarize the game plan for SpaceX, trade the edges of the 170 to 190 box and fade the middle. Reclaiming VWAP gives us a bullish bias, while losing the 170 shelf confirms a move toward the value low at 150. Sometimes, the market narrative gets it wrong. We've seen stocks like STRC, SATA, and MSTX labeled as scams by social media, when in reality, the filings indicated a margin call scenario that ultimately led to a massive short squeeze. Understanding mechanics is crucial. STRC, for example, is a preferred stock linked to Bitcoin. When it trades above par, the issuer can effectively raise capital, pay yields, and reinvest in Bitcoin. This isn't a Ponzi scheme. It's a specific financial instrument. The lesson here is to look past the noise. TikTok and social media often thrive on hyperbole, but critical analysis of the bylaws and financial structure will tell you the real story. Always verify the data before following the crowd. Let's look at the first Ponzi tell, issuance. For STRC, there is a hard floor at par. The machine is designed to stop issuing if the price falls below 100. A true Ponzi requires endless new demand to survive. This structure explicitly shuts down when it can't maintain that floor. The second Ponzi tell is the payment cadence. Scams usually try to delay payouts to stay afloat. In this case, the issuer increased the payment frequency from monthly to bi-weekly and even daily on related instruments. That's not the behavior of an entity in trouble. When we analyze what actually happened with STRC, we see a classic margin call, not a collapse. Leverage was forced out into the tape, creating a temporary flush. Once that selling exhausted, the structure remained intact, and the price reclaimed its levels. The sister name, SATA, saw the exact same pattern. Holders were running high leverage to chase a daily yield. When the margin call hit, they had to liquidate, but the underlying business logic remained distinct from the leveraged blow-up of its shareholders. Shorting this name can be a trap. If you short it, you are responsible for the dividend payments. With yields in the double digits, you're essentially paying to hold the position while waiting for a decline that might not come. The math is backwards for most short sellers. There is a deep irony here. Short sellers are actually helping the issuer. Because short positions shift the yield obligation from the company to the borrower, every short share effectively reduces the cash burden on the issuer. It's the opposite of a death spiral. Look at who is on the other side of these trades. Major institutions like D.E. Shaw, BlackRock, and Millennium are holding significant positions. While retail traders might call it a Ponzi, institutional money is betting on the structure remaining viable. Then there's the MSTX short. Mimicking MSTR through synthetics and swaps comes with a massive cost, roughly 89% annually. That decay is the edge. If you're going to trade this, you have to realize you aren't just shorting a stock, you're betting against structural decay. The professional way to trade this is to target the NAV premium, not just the man at the helm. MSTR should not trade at a massive premium to its Bitcoin holdings. When that premium gets overextended, that's your signal to fade it. Here is the desk recap. We are long STRC with protective puts and upside calls, betting the structure is sound. Simultaneously, we are short MSTX to capture the structural decay and the eventual mean reversion of the MSTR premium. Don't be a sheep. When you hear the word scam thrown around, treat it as a prompt to do your own homework. Read the filings, check the bylaws, and see if the logic holds up. Opportunity lives where the crowd stops thinking. Let's debrief our 3 core mandates. First, know the why of a trade so you can identify the when it ends. Second, trade the environment. Breadth sets the regime, not the daily news. Third, do your own work. Before you enter any trade, run this checklist. Is volume confirming the move? What is the core thesis, and what would invalidate it? Are we in a bullish or bearish environment? Are you relying on your own research, or just echoing someone else's conviction? A final reminder, this is not financial advice. Markets involve risk, and you can lose capital. The positions discussed here are examples of one trader's process. Always conduct your own due diligence and make decisions based on your personal risk profile. Stay on the right side of the tape. Check out our website and YouTube for more, and keep an eye on our upcoming challenges. July is bringing big changes, so make sure you're prepared. Subscribe, hit the bell, and keep doing your own homework.